Good morning, and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Alex Matthew. With me is Hiral Dadia. Morning, Hiral.
Good morning, Alex.
Lots to unpack this morning, starting with, of course, the Federal Reserve decision where they kept the rates unchanged. But there's a lot more that was gleaned from the commentary, and most importantly, the possibility that we may just be done with Fed rate hikes, for now at least.
Absolutely. So with that, from the domestic front as well, if you go to see, Tata Steel becomes the key talking point in today's session with the kind of impairment that they've taken. Now, the impact in terms of overall markets is going to be interesting. Second consecutive week of session of decline we've seen, and we've ended below the 19,000 mark yet again. Two sectors, real estate that continues the up move. Now, whether that will take a pause or not is what we need to wait and watch and see. And you have the auto pack. In spite of a good set of October numbers, you've seen a downtick that has come in with regards to the auto sector in terms of close yesterday as well, right? So overall, both of these sectors will be in focus, and the direction for markets is interesting because, yesterday, Agam, we spoke about that bottom, somewhere that is being formed, but that sell on rise is something which is absolutely picking up as well.
Absolutely. And one more sector I will add to what you've just spoken about, which is the metals pack, which was down about 1.5% yesterday. Tata Steel was down over 2%. And perhaps to a certain extent, there was an inkling that there could be some trouble in the numbers. Whether or not the magnitude of the trouble was anticipated or not is another question. And we will take that up with our guests on this show as well.
Absolutely. And Tata Steel, the metal pack, in fact, if you see Tata Steel itself, the stock is down almost 10% in the last 1 month, right? So whether the negatives are priced in, and now will the street react to that, or the management commentary is going to be interesting. But before we head across to any of this, let's just understand what the F&O data is indicating as well. Agam's joining by. Agam, yesterday we spoke about the bottom being formed, but now you are seeing that trend where sell on rise is something what the traders are utilizing right now. What's the sense that you pick up? What are the levels indicating?
Right. So, as far as the Nifty is concerned, we're keeping an eye on 18,900. We're going to keep testing 19,000 on and off here and there. I think the bottom may just get tested, considering we are seeing the second straight day of weakness, and we've actually, in fact, seen fresh shorts building into at least the index futures. So the Nifty, along with the Bank Nifty, futures, have seen a little bit of an increase towards open interest, towards fresh shorts. To very quickly talk about what's happening in the options market. Once again, the max OI in the put has moved down to around 18,800. Do remember, this is for today's weekly options expiry. And on the higher end, we're keeping an eye on 19,100. That could be a little bit of a hurdle as far as moving higher is concerned. As far as Bank Nifty goes, continuing to keep an eye on the 500-point range between 40,500 and 43,000. But in terms of the key triggers that would significantly move the markets, do remember that we are going into the second leg of the earnings, and it just so happens that the second leg of the earnings tends to come up with slightly weaker earnings. So that perhaps is going to be a crucial factor to watch out for as to where the markets may head going into the next few weeks.
Absolutely. Thanks so much, Akam, for bringing us those details. Let's focus in on the Fed decision and the implications it has for global markets. We're joined right now by Dean Kim, the head of research product at William O'Neill. Dean, thanks so much for joining us this morning. And we saw bond yields in the US plummet quite sharply, not just perhaps on account of the Fed decision, or in fact the commentary, but also because of the announcement of the sale of bonds by Treasury and the fact that it was slightly lower than it was expected. What did you make of the fine print of the commentary of the Fed decision last night?
Yeah, I mean, it's certainly the equity markets reacted positively, given the fact that the Fed is keeping its policy rates unchanged. So the S&P is running up against resistance at the 200-day moving average today, but the Nasdaq has reclaimed the 200-day moving average. So we're going to be looking for a strong update to call the market back to uptrend. So both S&P and Nasdaq currently in downtrend. I think we can take it two ways. One is the bond market is telling us that it's time for the Fed to start looking at lowering rates. And what I'm noticing is let's say 6 months ago, the yield curve is certainly inverted, but it was inverted by about 60 basis points 6 months ago. Today, it's inverted by about 20 basis points. So it's getting a little steeper. So that's actually a sign that the U.S. Might be headed for a bit of a recession sometime next year. Because when we look at past recessions, we've seen the classic signs of yield curve starting to steepen. So perhaps the bond market is now signaling that we may be headed towards some sort of recession, and we're not sure if it's going to be a hard one or a soft one, but looks like that's what the bond market is signaling.
Right. Dean, good morning. This is Hiral on this side. From the statement that we've heard last evening as well, do you think that the policy message is actually becoming more two-sided, and that is something which will actually keep investors pretty much on the tender hook?
Yeah, certainly the Fed is keeping their options open. They're reiterating the fact that, of course, next meeting, which is mid-December, we may see them reacting to data that's coming in. So they're keeping that door open in terms of raising rates. But when you look at all of the signals that are coming in, such as a bit of a steepening of the yield curve, the unemployment rate edging up slightly, and we have a U.S. trade deficit that's sort of running away, and that may put a lot of pressure on the economy. Some, bond market economists are calling for, we may see a reversal of rates heading into 2024. I think we're at a critical junction where we have to keep an eye on the data that's coming in. So particularly tomorrow, we're going to get initial jobless claims. So if it comes in a lot, cooler, then the bond market's going to react, and equity market's going to probably start to appreciate. But if job numbers, like on Friday, we're going to get non-farm payroll numbers. If that comes in hotter than expected, we're going to see the equity markets pulling back. So it's going to be interesting in the next few weeks.
Dean, I'm just curious what your view is on EMs as well, because if you look at other major central banks, of course, Japan earlier in the week, but Bank of England widely expected to pause today. The Eurozone inflation seems to be cooling just a tad bit. So there, the expectation is that they might just be done with the interest rate hikes. And the US now indications are that they might be done with hikes. So we possibly reached the peak of the interest rate cycle, but we've seen a lot of turmoil in bond yields. We've seen the dollar come off just a tad bit. What is your expectation for emerging markets?
Yeah, I mean, certainly when you look at emerging markets, for example, I look at AAXJ as the ETF for Asia, and the ETF continues to make lower lows and declining relative strength. So the markets are actually already pricing in, economic slowdown, and the fact that there is badly needed stimulus in the form of all these central banks needing to cut back rates. So I think certainly in the U.S., interest rates are at a unsustainable level where now it's going to start to impact consumers. And I suspect that's pretty much the same thing in Europe, and maybe not so much Asia because they're major exporters, but certainly you can see from the indices in Asia is certainly making lower lows. So I think it's time that the rates start to ease off and go the other way. But in between those 2 points, we're probably going to see some economic demise. Maybe short-lived, but markets will probably have one more knee-jerk reaction to the negative before we see bottom and equity markets starting to recover.
Right. That's going to be an interesting point to watch out for as well, from a market perspective, Dean. Thank you for giving us these details and joining us on the show. So clearly, from an FOMC perspective as well, it's a two-sided coin yet. What they do in December, what the trajectory looks like is going to be interesting to wait and watch, because they've absolutely not been 100% clear whether this is a pause or not. But let's quickly move on to the domestic markets, because Tata Steel, that's a stock to focus on in today's session on the back of the way the numbers have panned out. Clearly, if you see the loss number on the back of the impairment that the company has taken, that's one of the biggest negative and having an impact on the EPS as well. Joining us on the show is Rakesh Arora to give us more of what he makes of this, and we will have our in-house expert Sajid as well, who will be joining in to tell us as to what will happen from here on. But let's first go to Rakesh and understand as to what's happening with this one. Rakesh, good morning and welcome to the show.
Good morning. Good morning.
Rakesh, overall, an impairment that they have taken on one of the assets in the US, they are moving to greener in the UK, I beg your pardon, and they're moving to a greener version from, something which was absolutely carbon rich earlier. What do you make of this, and how do you see the impact in terms of the stock? Because it's already down 10% in the last 1 month.
Yeah, so see, this was kind of expected, but analysts didn't know that it will come in this quarter because the scheme was in the making for quite some time. And while the positives from this would emerge in the next 3 years onwards, but they have taken the provision now. So, which is a good thing, I would say, that it's out of the way. We yet to hear from the management as to how much more can come. But if this is what it is, overall, then I think it is good to get it out of the way.
Rakesh, if I can come in here, Sajid here. They have taken this impairment especially for Port Talbot, which is the UK assets, but they haven't mentioned anything about the mainland European assets which are there, where they are looking for some kind of help coming from the Dutch government. Do you see that the next round of restructuring, which will be for the mainland Europe assets, will see some kind of provisioning coming for those assets as well?
It's quite possible because they would be trying to do a similar deal with the Dutch government also, and that is what they've indicated to. So there could be further write-downs which can come in for the European operations. But see, as I said, that these are good long-term initiatives and will make European operations sustainable. So I think market would discount this. There won't be too much of reaction to these kind of provisions.
How do you see, you said that it came as a surprise because you didn't expect it in the second quarter. Were you expecting this by March quarter or coming in at the end of the year, and that's why it could be a surprise for the street as well?
Yeah, timing was a little bit of a surprise, but quantum is not. And from an overall perspective, it doesn't change anything because the street was not really expecting, that high value for European assets. So these provisions are just a confirmation that, the valuation for European assets are much lower than what is in the book.
Rakesh, Alex here. I think the attention is gone on this impairment and the implications for the P&L, but then we've not really spoken about the earnings. What did you make of the numbers that were reported on the operational side?
So that is where I think the major, pain is. The Indian operations, this time they have clubbed Tata Steel long product, numbers into the standalone entity. And long product didn't really do that well. So there's a minor miss on the, Indian operations. But European operations, both UK and Netherlands, are making, deep losses. And unfortunately, the situation has worsened in Q3 because coking coal has jumped from $230 to $350, and even iron ore is up to $121 from around 100-ish. So costs have gone up and steel prices are not moving, demand is weak. So European operations are going to bleed further. And so overall, I think, things are looking a little bit bleak for Tata Steel from earnings point of view, not just the, lower numbers this quarter, but even Q3 and Q4 are looking weak. So consensus estimates would have to be cut The last I checked, they need at least a 20-25% cut at the EBITDA level for FY24.
Right. So overall, another question I have from an EPS perspective, Rakesh, is from a second quarter of FY23 when the EPS was around 1.24. This quarter, it's gone down to a negative 5.07. Now, taking this into consideration, and as you mentioned that the analysts were not, probably expecting it in this quarter, how are you expecting the stock to react, number one, in terms of open? And two, what would you advise investors to do with the stock?
So, see, analysts would be looking at, a cleaner balance sheet and numbers for FY25 while giving their target prices. And as you're mentioning that the stock has also corrected from its recent peak. But given the outlook which I portrayed, it's negative, I think there's further downside. So maybe there's a knee-jerk reaction today. But overall, I think it can retest the 100 rupee level where it was stable for quite some time.
Understood. Rakesh, thanks so much for that perspective, and thanks so much for taking the time and speaking to us this morning.
Thank you.
And Sajith as well, thank you so much for giving us perspective. Let's focus in on the other companies that are in focus. I said that twice, but then it bears watching anyway. On the earnings front, we've got GCPL as well as Britannia to talk about, and we've got Sesa joining in. Sesa, good morning, and what are the key highlights that you're picking up from these two companies?
Right, I'll start off with Britannia Industries. So the company has reported a muted top-line growth, even as it reported a strong operational performance. Revenue was up just 1.2%. A net profit rose 19.6%, beating estimates. Operating profit rose 22.6%, which was also higher than the consensus estimates. And margins expanded 343 basis points over the previous year to stand at 19.7%. Despite higher advertising spends. Now, volume growth is estimated to have remained flat. During the quarter, Britannia continued to expand its rural distribution despite the reported rural slowdown. With the softening of commodity prices, Britannia said that it has witnessed pricing activity by local competitors in certain categories. And to stay ahead of the curve, the company undertook price cuts in key brands, leading to some recovery in market share. Now, going forward, the company highlighted a key challenge that could impact the business. It said that the global commodity prices remain volatile amid the ongoing strife in the Middle East and Russia, and that the company is watchful of this situation. So we need to watch out the management commentary during the analyst call that is scheduled today. Now, coming to Godrej Consumer, it has reported a strong show as expected, with volumes up 10% in a relatively muted demand setting. Revenue rose 6.2% over the previous year. Net profit was up 20.6% to 433 crore, but it missed the consensus estimates owing to higher tax rate. Operating profit jumped 30%, while margins expanded 320 basis points year on year to 19.5%. Now, this also was, again, despite a 29% rise in the advertising spends. Revenue growth was lower than the volume growth, primarily due to the lower prices in personal wash, translation impact in Nigeria, and hyperinflation accounting in Argentina. Now, from a demand perspective, we continue to see that the K-shaped recovery with premium offerings doing well, while mass offerings stay under pressure. Within the categories, the home care portfolio grew just 5%, while personal care sales declined 1%. The company has improved its India business sales growth on the back of multiple initiatives across geographies under the new leadership. The street estimates that initiatives like disruptive innovations, access packs, higher but concentrated ad spends should result in consistently high growth in GCPL's high margin domestic business going forward.
Right. Thanks, Isa, for getting us, how both these numbers look like. And we will have a Dabur that will be in focus. We will come back to you on it a little later during the day. We're running out of time, but watch out for all of these three FMCG players pretty closely in trade. Moving on away from the FMCG pack, as we mentioned, auto has been in focus with regards to where the auto sales numbers that have trickled in, though the index as a whole over the last 2 to 3 trading sessions has been under pressure. Vinay is standing by to help us understand more in terms of of how the Hero Motor numbers have panned out. Vinay, over to you. What do you make of Hero Motor?
So this was a beat on the profit front because the margin expanded quite significantly. The margin expanded 270 basis points to 14.1% due to lower material costs. The profit was higher by 47% due to this expansion in the margin. The surge in profit was driven by better pricing and cost-cutting measures. As we said, the raw material cost declined in the quarter compared to the previous quarter. And the margin expansion was not due to the higher sales because the sales declined 1% in the quarter. And due to this, the impact is seen on the revenue of the company, which just rose 4% in the quarter.
Vinay, hold on with us. We'll come back to you for the preview for the next company we're talking about is Tata Motors. But before that, we'll talk about earnings that have come in overnight. And Varsha is joining in to give you some perspective on that. Varsha, I believe you're starting with LIC Housing Finance.
Good morning, guys. So, LIC Housing Fund has reported nearly four-fold rise in its net profit to rupees 1,188 crore. Now, this was on the back of robust growth in net interest income and decline in provision towards impairment in financial instruments, even as overall loan disbursements were lower. The net interest income rose 83% year-on-year, while the provision towards impairment in financial instruments declined 26%. On the asset side, if you see the net NPA declined marginally to 2.59% against 2.83%. Next, we have Syrma SGS, where the revenue was up 52% and EBITDA was up 4.3%. If you see, the company's reported profit was up 7.8%. Now, company has acquired 51% stake in Johari Digital Healthcare. Now, this business has a high margin, which will improve company's margin in future. Note, the margin for the current quarter was 6.9% versus 10% last year. Now, this was due to increase in cost of material, which was 77% of sales last year versus 81% this year. Then we have JK Tires and Industries, where revenue was up 3.8%. And if you see, there was uptick in EBITDA margin, which was led by improved operational efficiencies, product premiumization, further supported by raw material prices. Also, company has 30% revenue contribution from OEM versus 15% last year, which helped financials. And net profit, if you see, was 248 crore versus 49 crore last year. Now, this was on the back of EBITDA margins. Then company has approved investment of 1,000 crore for expansion of tire manufacturing capacity, which will increase its capacity by 20%. Then we have Kansai Nerolac Paints, where revenue was of only 1%, but demand for performance coatings was relatively better, and EBITDA was up 37%. If you see margins, it was 13% versus 10% last year, led by decrease in cost of raw material, which fell more than 8%. And during the quarter, product mix improved due to sale of premium products. Also, going forward with normal monsoon and delayed festival season, demand for decorative is likely to show traction. Lastly, we have Responsive Industries, where revenue was up 9.5%, EBITDA was up 4.35x, and margins were 22% versus 5% last year due to decrease in material cost, which was 75% last year, came to 62% this year. And if you see net profit, which was 40 crore versus loss of 5.8 crore last year.
Right, a lot of companies to watch out for across sectors from the broader markets. But thank you, Varsha, for getting us these numbers. Moving from reviews to previews, you have a Tata Motors that will be reporting numbers from the auto pack. We have Vinay back with us to tell us more in terms of what's expected. Vinay, will the company turn profitable yet again?
Yeah, it is likely to report profit for the fourth consecutive month. And this is largely due to JLR sales in the British subsidiary, which the JLR sales rose 29% in the quarter. And this was due to the improved supply of semiconductors, which was limiting the production. In the domestic front, the Tata Motors Company's passenger vehicle sales fell 2.4%, but the commercial vehicle sales rose 3.5%. So there is this mixed bag at the Tata Motors Company. The revenue is likely to jump 37%. This is largely due to higher JLR sales. And the margin is also likely to expand due to the improved performance of JLR. The margin is expected to expand to 12.7% from 7.9% in the previous quarter.
Okay, thanks so much, Vinay, for bringing us those details. Let's quickly take you through a few more stocks that are in the news that you should watch out for in trade today. Rishi is joining in with that list. Morning, Rishi. What are your top 3 stocks?
So firstly, there will be GAIL and BPCL. I'll club them into one because they've entered into an agreement for 15-year supply of propane. Now the contract will have an estimated value of 63,000 crores. Then you have the Murugappa group of stocks that may see a reaction because the family arrangement is now effective and parties have agreed to withdraw all the legal proceedings within the upcoming days. The stocks you need to watch out for would be Tube Investments, CG Power, Cholamandalam Investments, Coromandel, and all the other Murugappa group stocks. Then there's GIA Infra Projects, where it has executed a concession agreement with NHAI, and this is for a four-laning of the NH 530B in Uttar Pradesh with an estimated project cost of 1,200 crores, and it is estimated to be completed in about 2 years and another operational period of about 15 years.
Right. These three, absolutely, our eyes will be on that, Rishi. Thank you for getting us the details. We're completely running out of time, so we'll quickly wrap the show. But up next, you will be able to hear the management of IGL. In fact, if you see in terms of their numbers, the profits have risen. However, the revenues have missed the street estimates. Also, let's hear in from the management what they have to say and what the trajectory will look like going forward. That's all that we have in the session. Thanks for watching. And this is BK Prime.